Let today be the last day you will have problems solving double entry questions. Oh, pardon my manners. Hello everyone. Welcome to Accounting Learning Hub, and today we'll be treating principle of double entry. Before I proceed, we can't talk about double entry without mentioning one particular name, and that is the name of the Italian monk, Luca Pacioli, who was the first person to explain principle of double entry in his book published in 1494 titled Summa de Arithmetica Geometrica Proportionali et Proportionalita. Pardon me if I can't pronounce that correctly. I am not an Italian. Luca Pacioli is regarded as the father of accounting because he paved way for modern accounting. And now back to principle of double entry. It states that for every debit entry, there must be a corresponding credit entry and vice versa. You all know that, right? But did you really understand it? Let me show you how principle of double entry really works. To solve a problem on double entry, you need to follow just few steps. The first step is to identify the transaction. You need to know the type of transaction that occurred before you can know what to do with it. The second step is to identify the accounts that are involved. Every transaction affects at least two accounts. You need to be able to identify all those accounts before you can proceed. Lastly, identify the giving account and the receiving account. If you can do those three, you have no problem. There are many rules of double entry. Let me write some of it, some of the rules. We debit the receiving account and credit the giving account. So after you have identified the account that are involved, you debit the account that is receiving and credit the account that is given. There is another way for you to have double entry problem solved easily. There is a formula PARLS, debit credit. This P stands for purchases. All our purchases accounts, whenever we perform a transaction and there is purchases account will be debited. Same thing with expenses. If we have expenses, if we incur expenses, we have to debit the expenses account. And the last one here is the assets. If we purchase assets, we have to debit the asset account. So all these three, if they increase, we debit the account, and if they reduce, we credit the account. And for the other side, we have revenue. Revenue like sales, discount received, etc. Whenever there is revenue, we credit the account, and when there is liability, we credit the account, and when there is sales, we also credit the account. Do you get that? So let's try to solve one question on double entry now. Purchased goods by cash, 20,000 naira. Now, let's follow the rules. The first thing is to identify the transaction, and we can see that this is a cash transaction because it is written here, purchase goods by cash. And what did we do? We purchased goods. And the next thing is to identify the accounts that are involved. The first account is purchase, because we already see purchase goods. We have purchase account. And how was the purchase settled? By cash. So the second account will be cash account. Then the next thing is to identify the giving account and the receiving account. So which account are we debiting? Which account are we crediting? From the rules here, purchases account will be debited. So we don't even have to think a lot about it. We debit our purchases account. At the same time, if you follow this rule, we received goods when we made purchase. So the receiving account is purchases. Then the next one, since we have identified two accounts, we just follow the rule of double entry, which stated that for every debit entry, there must be a corresponding credit entry. So the corresponding credit entry will now be cash account. And that is because we gave out cash of 20,000 naira. Our cash reduced by 20,000 and our purchases account increased by goods worth 20,000 naira. Do you get that? By next class, we'll be solving more questions on principle of double entry. Please like, comment and share. And if you are yet to follow, kindly click on the follow button. Thank you very much.